Today is August 22nd, 2000. Just one second. 2015. It's 9:24 or 9:25, 9:23 a.m. Eastern Standard Time. This is Clueless 8 Frank. Full disclosure, this is purely for financial education and not for any financial solicitation or advice. And I'm just going to do a quick roll call. Sherry, you there?
Yes.
DW?
Yeah.
Yep.
Okay.
Yes.
Guru?
Yeah.
Jack?
Right here.
KJS?
Yeah.
Excellent. Mary?
Yes.
And one of our very active traders, Vix.
Yes.
Okay, terrific. So we have a good crew in here. All right, so like I said, this is purely for financial education, not for any financial solicitation or advice. So let's kick off. Let's kick off this webinar. First of all, I want to start off with I have to collect my thoughts on what I'm going to talk about and how we're going to cover this webinar. Now, within this hour and a half that we're going to cover, which is normally what it lasts, we can't cover everything. We know that, but we're basically going to try to analyze and understand what is going on and try to make some sense out of it. I have a bunch of years of experience, and this chart pretty much around this time frame is when I landed on Wall Street, and the learning process over the last I would say wow, it's like 19 years. I was on Wall Street for about 14 and a half. So is something that I apply to my investment and trading thesis. Experience is the best teacher in the world, and all of you guys know that. And that's something that no textbook will teach you, and no technical analysis will teach you. There's a lot of gut feeling that you have to apply in what you do. So that's what I try to share with people, as you all know. So let me just get straight out here. So I'm going to draw some broad pictures. All right. So I'll leave questions for a bit later, and I'm going to start doing this right in real time. So here we have a monster breakout. Now, one of the beauties about technical analysis is that you can actually look back in hindsight, and it makes a lot of sense. And while we're going through it, and these are large cycles, by the way, you're talking about, yearly cycles. While we're going through it, it's very difficult for a human being, for an average human being, or any human being for that matter, to make head or tail of what exactly is going on. There are two things which happen in markets, which happen in trading and investing. It doesn't matter whichever way. Trading and investing are basically the same thing. One is more shorter term, one is a little bit more longer term, but they're the same format. You're putting money at risk on an intangible piece of paper, on a company that you might or might not know, and you're hoping to make money off it. That's really what it is. So one of the things that early this morning when I was out taking my dogs for a nice long walk down the waterfront, nice 3-mile walk, I was thinking that, and I go through, I read voraciously, so I'm just looking at so many different things, and I'm trying to say which, I can tweet out 30 different articles, postings and stuff that's out there, because this is huge fodder for the media. We all know that this is huge, global markets, U.S. markets, you name it. I mean, this was a perfect storm. It is still a perfect storm, by the way, just so you all know. And bear with me one quick second. I had to get my quick little sweatshirt because I was starting to feel cold, and I was wondering why in my den here with all my monitors and everything. It's because the monitors are not flickering and there's no heat coming out of the monitors, even though they're on, right? Because the market's off. So that's pretty much what it is. Oops, sorry. Bear with me one second. Okay, can everyone hear me?
Yep.
Yep.
Okay, good. So I just had to grab that. I didn't want to freeze while I'm talking to good people like you. Um, all right. So the first thing that went to my head is there's sensationalist articles, both on the bullish and the bearish side. Obviously, more on the bearish side right now. And then there is there are very sensationalist articles which are so depressing to read. Not to me, I've gone through all this stuff, but to that person out there. And then there are these and then there are these extremely stupidly bullish articles like, oh yeah, this is all going to be over on Monday and we're back to the stuff. And it's just they're playing upon people's emotions. That's what the media does. That affects your trading and that affects your pockets. There's no question about it. And I'm talking about both on the bullish side and the bearish side. Okay, and they're both vocal on both sides. On the so finally, as I'm scanning through, I come across one which I tweeted out there, which I wrote my line, which was tweeted 45 minutes ago. It said a balanced assessment markets, and that's from the Guardian in the UK. For some reason, whoever wrote that article didn't want to create like New York Post page 6 headlines. You know what I'm saying? Pictures of massive stuff. So that's the one that I put out there. So as we move along, after in what the market's doing right now, you all will be swayed big time by major news flashes and sensationalist articles and analyst commentary that's going to affect your trading. I'm telling you right now. Okay, there is no way to create a balanced atmosphere in the middle of a firestorm that the markets are going through. Okay, and it's the same way when the markets were like ripping up, when I couldn't, when every morning when I woke up and price line is up $30, I'm just like, come on, unless I'm long the previous day or and just having a large position. I hate chasing crazy stuff. I mean, there are limited amounts of chasing that I do. You all know that. Netflix, when it was ripping up, I was chasing it, and technically it played out fantastically well. But chasing and chasing and chasing things that they're just ripping up, the cyber stocks, for example, when they start to go berserk, biotech stocks when they go berserk. So and some people are very good at it. Some people just go out there, throw the dice out there. Things going to be at 600, things will be at 700. Just keep on throwing the dice out there. I can't do that. I'd like to have some sort of technical basis why I do things. Now, saying all that, many of you, including myself, have missed out on some large trades on the upside. So now we have this huge drop in the market, which the first initial gut reaction by over optimistic traders is, man, everything's on sale. That's it. This is it. This is the time to really get in there, and I'm going to make those 100 points that I missed out on the last run. Well, I have news for you. You're going to get burned. You're going to get burned. Because the reality of the situation is that and we're going to do some microanalysis on this SPY chart in a second. The reality of the situation is that just because you think something is down big, honestly, things are not really down not that big. We're just back to where we were 2 months ago, to be honest with you. Less than that. So the point is that just because you're buying it because it's down, which I hear a lot in the trading room, on stock twits, other forums that I look at, it is not that's not the smart way of doing things. That's not the smart way of doing things. Thank you, whoever muted that thing. There was a lot of background hiss. Okay, it's back again. Whose microphone is that? Because everyone mute their microphones, please. Hello? Somebody's microphone is on.
I'm looking to.
What was that?
No, I'm looking to mute my phone, but I don't think it's me. I'm pretty quiet over here.
Yeah, I know. It just keeps on coming back. Anyway, it's not that loud, but still. So looking at the broader picture here in the coming days, in the coming weeks, okay, just buying things just because they're down is the stupidest game in town. You're going to lose money. You're going to lose money so fast you won't even know it. And technical analysis and the way the way I approach these type of things, the way I do these a very unorthodox type of technical structures and things like that, which are quite different than what's out there. It's going to be far more critically important than you ever imagined. I'm not going to make some big broadcasted call that this is the end of the bull market. This is the beginning of the big bear. Because honestly speaking, let me be straightforward. Making macro bets on the market has never made anyone any real money unless they're a $1 billion hedge fund or a mutual fund manager with $30 billion at their disposal. Because the reality is that what happens 6 months from now or 3 months from now, to be honest with you, is not going to put any money in your pocket. It's not. You know, since 1996, 1997 period, looking back at this, right? How many cycles have I gone through? I didn't really quite understand the real dynamics, what the real story with the markets are till about this point, somewhere here in 2006. It took me a full 10 years. Did I understand why things were happening? Sure. The Asian flu, you know, this was the Asian crisis, and then the big ramp up into the tech bubble of 2000, which is right there, the tech bubble of 2000. This was the point where maximum amount of investor investment involvement in the U.S. financial markets ever. Not here. And forget here. Most investors totally missed out on this. Other than they didn't fully miss out because their 401ks and their other stuff went up humongous. So it's not that they missed out. I'm talking active involvement, diving in there and saying that's it. I'm getting in there. I'm buying stocks of my own. I'm going to trade like crazy. I believe the markets are going to go higher. They totally missed out on this. This was a whole big negative, a big zero. Okay, a big zero, as in real investor euphoria or excitement about the stock market. Okay, this was the point. This was the point when everyone thought if they bought a .com, they would be a billionaire, and they made some money, no question about it. You know, this is 2000. And then after this happened, and a lot of things happened in the middle, of course, you know, 9/11, the Enron crisis right here, the whole credit bubble, full burst. After that, they burned. They were just like, forget it. I'm not going to touch the market ever. It's more, you know, market's just. So they missed out a good portion of this, then started to get a little bit excited as usual right here. Okay, right here. And then came the big credit crisis, the housing market. At this point, they started getting excited because people were making a lot of money on houses, residential, just the way some of them are doing right now, except the flippers were at maximum move here. Okay, so they started pouring some money back into the market. Then came the big meltdown, and this wasn't the stock market meltdown. This was because of the housing, because the housing market was so hot that they packaged every single living thing that came out of mortgages and sold it to the rest of the world. That's the reason why the housing bubble burst. It had really nothing to do with stocks. It was a credit crisis created by the housing bubble. And then came the big move up. So without going on and on, because there's so much so much stuff to talk about when it comes to that, what's going to happen over the next couple of weeks is the bad news is the sell-off ain't over. So if somebody's like just wanting to just buy there and sit there and, oh yeah, I'm going to make a lot of money because the market just dropped 1,000 points, and Clue's been talking about this move, but he said it was going to be in October, except it happened in August, right? I really expected this to happen in October. And 16,000, on the Dow. I've covered this extensively with many of you in the coaching sessions. We'll look at the same chart again and see, that's exactly what's going on. And so it's not going to be easy. The great news is, and I'm not making this up because this week was one of my really good weeks. All right. and I don't even touch your money. This is my money that I'm trading. So when brokers sometimes on Wall Street in the old days say, I had a really great week. Yeah, they had a great week because they were probably selling out their clients or moving them into garbage stocks, telling them that it's going to go higher, and then making commission of that. Well, none of that stuff here. This is just tactical trading and doing what was necessary, moving fast, and great. So the great news is that all of you, if you are reasonably knowledgeable in this, in what the game plan is, I'm trying to paint that out, and reasonably active, they have to be, and track every single thing that I'm putting out there, which are literally tactical roadmaps, so that you don't crash into a tree. Then you're going to make a lot of money, because the fact is that your time frames have to be shorter. The time frames have to be shorter. It's very simple. You all know that. In the sense that we just had blunt trauma. The car just crashed, but the passengers are still alive. So you have a major opportunity here as we get towards September, going into October, going into the end of the year. Okay, that's as far as I'm going to go for now, as in projection, to make a crap load of money, because the swings are going to be. You think the volatility that we went through was bad? It's going to be worse. So you got to play the directional bets within shorter time frames with smaller amounts of money, and not believe anything that you see on the screen, because the way things are, and I'm going to get into the reasons behind that in a few minutes. The way things are, you're going to see rapid volatility, random movements, keywords that I use, intraday, intra-week, and you have to be prepared for it. Now, I don't really know whether I think preparation for volatility is like an oxymoron, because how do you prepare for random events? Well, the way I live my life and the way I look at the markets is you prepare for it by assuming that this is going to be very hard, and then whatever happens is going to be reasonably easy. It's a game of relativity. The stock market game is a game of expectations. What is the mass psychology expecting? So sometimes you have to go against it. Sometimes you have to play with it. There's what do you call? There's a saying that you always have to be a contrarian. Always have to go against the grain. Not true. When the herd mentality takes over and the market really wants to break down further, okay? The market really wants to break down further. Then you have to go with the herd. Maybe you have to be one step ahead. Being a contrarian is fine, and going against the grain, which I've done a lot, which I'll still keep on doing, is fine and good if the background under what the way I analyze it and the assessment that you make on the technical side is in your favor. Just by going with sentiment, at this point, honestly, that fear greed index is broken. It should actually be at 0 right now, because there's so much fear and non-involvement in the market. But it's still, every time I click it, it still shows that it's at 6 or something like that. So what the paradigm that changed? Oh, it's at 5 right now. Okay. So the paradigm that changed over the past week or so, and things do change. I've said this before, and I'll say this again. What took months and years now happens in days and hours. Don't want to accept. If anyone doesn't want to accept it, well, they're going to hurt. They're going to hurt. You have to accept that the machines are so fast from here to Timbuktu. I'm sure somebody from Timbuktu is on their iPads trading. Is the fact that it will happen very quickly. Therein lies the opportunity. The faster it moves in one direction, the faster reflex bounces, the reflex corrective bounces, call it a dead cat bounce, call it a retracement bounce, whatever fancy term we want to use, are going to be equally harder. Then they'll fail, then they'll hard, and then we'll see what the general direction of the market, is going to be. We won't know that till 6 months from now, whether it's going to be this or whether it's going to be a corrective action and then it moves from here, makes a new high, or whether or not we are going to basically, and I'm going to show this very quickly, where I think where the Dow eventually can land up. These are multi-month affairs, so you can be sitting around dealing with multi-month affairs, because honestly speaking, some of the biggest money is made in the midst of massive bull market corrections, because the reflex bounces are so big. You don't think we're going to have a 400-point up day one of these days? You sure are. Believe me, there's going to be hard ones, but they have to be sold. Sentiment overall, technical sentiment, not emotional sentiment by the retail investor, because the retail investor involvement, as I've said repeatedly, is almost non-existent as in active trading. I'm not talking about you guys and stuff. I'm talking mom and pop out there. So the point is that the technical sentiment has changed. So let's dive in a little bit about the causes of this, so you guys are fully aware of it, and many of you already know it. There's a global currency credit meltdown happening. When countries like Kazakhstan, in overnight, devalue the currency by 40%, and I would say a good 99% of traders have no frigging idea what Kazakhstan is. Of course, actually, they know the name because Borat, the movie, that very funny movie about the crazy hairdresser. He was a Kazakh, right? But aside from that, nobody. If I asked anyone really directly, like, why is it such an important linchpin in the global economy? Well, one of the reasons is because they have a shitload of oil. They're a very rich country. They are one of those Soviet republics that became independent, after the breakup. Huge amounts of oil. So anywhere with and huge amount of wealth, hugely corrupt, all the beautiful ingredients to be really rich. Okay, so and billionaires being printed literally every couple of months. So those guys basically got hurt. It's oil. Oil, slippery business. Oil's bad when it's this low. Oil's bad when it's very high. Remember back in 2007, if I remember correctly, oil was at like $100 dollars, right? It was 117 or something. We can look at that in a second. So both extremes of oil, below 30, above 100, is crazy stuff. Well, for not for them. I mean, they were just, it's just raining money. Right now, they're draining money. So China started off with their devaluation for their own reason, trying to boost their exports, trying to artificially boost their economy and stuff like that, and that caused a massive ripple effect across emerging markets. This is really an emerging market crisis. This is the same stuff that happened in 1998. Okay, during the Asian flu. So you guys can Google it and read it sometime. Hedge funds blew up. Long-term capital, which was run by one of the legends of the money management business, John Merriweather, and it was just huge. So bottom line is, this is an emerging market crisis that is having blowback effects into us. The U.S. economy is doing fine, by the way, overall. I don't care whichever way you slice it or dice it. There's a lot of positives going on, but when it comes to the global credit situation, things are bad. And it's not something that's going to reverse itself in one day. So just get prepared for that. So the blowbacks are going to keep on hitting us, but eventually, whether it be 6 months or whether it be 8 months or whether it be sooner, the eventual winner is going to be the United States of America. Not Canada, not Australia, not New Zealand, not Saudi Arabia. And I'm not picking Canada, I'm just saying, because we have Canadian members here in our group here just this morning. And I'll tell you, you guys are in some deep trouble internally. But because you're a smaller country and you guys can manage things better. But this oil situation keeps on going on, this commodity situation. You know, it's going to hurt massive commodity-driven economies. But Canada is not just a commodity-driven economy; it's a huge high-tech industry, all kinds of stuff. It's more of a varied industry. But Australia, Brazil, all these countries are basically they're Brazil's like full-blown recession. Not that you know that if you go to Party Rio or Sao Paulo and stuff like that. My buddy's from there, and that's different. But I'm talking the general economy. So this is the blowback. This is coming. All right, and it's a corrective action that's going to hit our credit markets and do certain things to us. So that's number one. China is a major issue. We all know that. But who didn't know that China wasn't slowing down? See, that's already kind of built into the market. And the Chinese will do whatever it takes to control their situation. So that's, I think, can be reasonably handled because they are not as open a global market. And as you can understand, that the more open you are as a global economy, like we are as a country, open to the to the global markets. China is open, but it's opening slowly. So the internal effects of their stock market and stuff are not felt worldwide as much as it would have if it was happening here. I want everyone to understand that clearly, because the Chinese market is primarily dominated by Chinese investors. Ours is different. Our markets, you got global players playing in our market every single day that you're trying to make money off the markets. All right, so that's so we have our doors open when it comes to capital controls and stuff, right? China doesn't. So in a way, that's good because that you don't see like a massive outflow of things and like waves coming in and out because it's primarily their own waves that's lapping around. Just trying to draw an analogy. So you have that. Then you have this fear that the global economy all of a sudden came to a screeching halt because of the Chinese slowdown, because of the currency devaluations, thanks to oil and commodities. Not just oil, it's copper, other metals, other industrial metals, I should say, and stuff like that. And it's a sentiment shift. Then we have the Federal Reserve. Now everyone thinks that the Fed, I don't know. I mean, my bias is the Fed probably raises rates in September, but there's a massive fear that even if they raise rates on a token level, and given the amount of anxiety and hardcore panic that's happening across the world, that even the fact that they raise rates a token mere quarter of a percentage point, which does nothing, which really doesn't affect us whatsoever, okay, is going to send another shock wave or a tremor, aftershocks as they call it, through the emerging markets, and they'll fall another leg. So that's the biggest fear right now. So if they don't move, let's see. They might say, hey, listen, there's a lot of stuff going on. Because one of the things that American investors don't understand, and traders forget it, they never understand, is that what the Federal Reserve does is not just for our benefit. It's for the benefit of the global economies. When they cut rates and started doing QE and stuff, not just for us. Of course, it pushed in liquidity and caused this type of rally that, I repeat, 99% missed, and I think most people were getting excited at these levels. Okay, the euphoria stage was more like around here, even though it was on the low end, but still, they were not here. They were not here. They're starting to get in here. So bottom line is that the Fed, even if what they're going to do in September, I don't know. But if they don't do anything, you might get one of those monsters, face-ripping 2,000-point rallies, which is just going to be that sigh of relief. Oh God, here we go. Thank God they didn't do that. All right, but they'll certainly move in December, no question about it. So the point is that there is a relief rally coming, and that's just the way things work. You get massive move downs and you get relief rallies, and then in this particular cases, and we're going to get into that right now, they continued forward. My gut tells me that whatever relief rally or not, we need to correct more, and we are not going to be moving in this direction. And honestly, brings me to my most important point of the day, and I hope all of you understand this. I honestly don't care whether the markets go up 1,000 points from here or down 1,000 points from here. I just need to catch the bulk of the move. And if you guys train your mind to think like that, and again, you don't need to be an options player to do that. You can buy these ETFs which are inverse to the markets or asset classes. You can buy the UVXY. You can buy the inverse of any of the major ETFs, asset classes through an ETF. So the point is, and I want you guys to really start thinking from today onwards. Forget the bull market right now, all right? Because the bull has been severely injured right now. I don't care what people say. I'm a messenger of the markets. I don't dictate the rules. And all of you have heard me say this repeatedly. And sometimes I go into the face of my members and traders and tell them straight out. Don't ask me what it's going to happen like a day from now or so. I have to sit back, reevaluate the situation. That's what you do in battle or in corporate planning. That's what you do. Tactical, strategic planning. So what happened over the past week or so? You have to reassess. I hope that's very clear to everyone. You have to reassess and change your mentality. Adapt or die. That's basically what it is in this business, whether it's investing or in trading, especially in trading. If you don't adapt, you will die. If I didn't adapt over the past 2 weeks, and if I didn't warn people in between those massive spiked rallies, where I'm just like, where am I going wrong? I knew it wasn't going wrong. The overall trend looked like they were going to correct and do this, but in between you get these big rallies. So if you're a little bit short, like, oh, forget it, that's gone. And then this type of stuff happens. That webinar, market webinar that I did, it's it's an hour and 40 minutes long. Suggest everybody spend some time listening to it. It's actually a full-scale advanced coaching session that I basically released it out there for people to listen to. And what was the headline of the webinar? Prepare for the downturn. What did the markets do within 24 hours? See you later. I just wanted to warn people, like, look, these are things happening. So don't get all like, and do what you need to do, which take hedges. Don't be thinking, why are things going down? That, by the way, no offense meant to anybody, is like the dumbest statement to make when you are in the stock market. Why are things going down? I have a simple answer: because there are more sellers than buyers. Why is this stock getting hit when it's got nothing to do with that? That's another thing that you hear from a lot of investors. And it's dumb, but it's actually a kind of a human reaction. Well, it's happening because there's large-scale sellers in the market. Hedge funds which own those stocks know very well they have to come up with money, I repeat, to pay their big fat $50 million margin calls because they have a large gold position. Gold's actually been doing just reverse recently, but oil position, or they have a large position on Apple. So when those things are blowing up on a short-term basis, not blowing up, but it's correcting, then they have to come up with the money to preserve those positions. So you think hedge funds, forget it. They borrow so much to buy things and trade things. So they're hugely leveraged. The mutual fund, the average mutual fund out there, they have leverage too. Mutual funds are not just with buying stocks and other assets in the market with cash. They're buying, they're using margin. So the fact is that why are things going down? Just the way it happens. Nothing new about that. Why is it not going up? The good news came out because there's some sellers out there selling, using that chance to maybe sell that stock. So saying all that, what it comes down to, guys, ladies and gentlemen, is there's a huge opportunity to make very decent money, but you cannot. You have to be extremely tactical. Now, how you manage that in your own mental process, I don't know. And I can't teach you that. If you think that all this is just random, then you're truly clueless. I mean, truly ignorant. This is not random. This is a structured process in play right now. How does technical analysis benefit you guys? And what I try to do every single day, every single hour when I'm involved with people, as well as, my video casts and my constant Twitter feeds and stuff like that, is I believe that gives me a more of a reasonable roadmap a larger number of probabilities, which I have to assess and see without just driving blind. On summation of this mini commentary, let me just put it this way. If people really want to, this period that we are going to enter, and have been for the last couple of months, that we're going to enter now, is going to be the best thing, honestly speaking, that happened to your lives. But in order to do that and to maximize your money, you have to do the hard work. If you think you can just walk into the day at 2 in the afternoon and 1 in the afternoon and say, hey, what's good to buy? You know what? That's fine. That's great. What's good to buy? You can't do that. Now, that doesn't, I mean, you have day jobs. So what are you going to do? You know, it's not your fault that you can be monitoring things on a minute by minute, hourly basis. I understand that. So what's the solution to that? The solution to that is that at the end of the day, you have to spend at least 30 minutes to, forget an hour, you know, let's say 30 minutes. All right. Not everyone has to be you know, do people know the word wonk, W-O-N-K? It's not from Willy Wonka, by the way. Anyone know the word wonk? It's basically somebody who's just like hell bent and like a nerd, hardcore. All right. So you don't have to be a technical wonk like me and sit there and like stare at charts, which I do, and just trying to make head or sense of what's going on. And over the years, believe me, you know, I've understood a lot. So you don't have to do that, but you have to spend at least half an hour going through the Twitter feed. It's not that hard. I write English, quick lines. I show visuals like no one else out there. So they're right there. There's a story being told. And if you do that on a systematic basis for the next couple of weeks, that's not really hard work. Okay. That's just spending a little bit of time. Then you yourself will realize how much money you can make in this market. But if you don't, and you come in the middle of the day, whistle in, and bang. You know, it's like those cartoons. You get swiped in the head. I mean, a big boulder hits you because you buy something, you know, middle of the day. Like, okay, you know, I'm doing that. And or you buy something, goes up a little bit, you don't have stops in there, whatever the case may be, and then you're like, oh man. So can't do that. So this is, but for people, and a bunch of you are in here that I know personally, who are really tuned into it, guys, you're going to have the best period coming up over the next couple of months that you will ever imagine. And it's not going to be easy. So let's go in like my dad used to say. If you when you grew up as growing up, you know, he used to say, if you think everything is hard, life's easy. And you know what? That's just the way it is, guys. So let's you know, I'll stop my Tony Robbins stuff and get straight into the technicals. So let's do this here. Everyone can see the screen? Is everyone still there? Yep.
Yes, you told us to mute.
Yeah, I know that. I know. So that's fine. So you can keep that muted. So we're going to draw some lines here, okay? Just to give you a broader picture, then we're going to get into the micro picture. Which reminds me, technical charts on individual stocks in general are broken right now. Broken. Not necessarily like they're going to be in a one-way free flight zone down, but just as in very accurate technical analysis, it's going to be a tougher call. I just want people to understand that. So it doesn't mean all of a sudden I'm going to stop showing individual stock charts. But I highly recommend that for options players at this stage, you devote more time on the indices, which are cleaner to read, bigger money to be made, in my opinion. And of course, trade the individual high momentum stocks and stuff that we trade up and down. But because their chart patterns are so erratic now, they're much harder to read. So I'm just letting people know. You can do that. Yeah, go ahead.
What are you doing with your long-term investment basket?
I'm not going to even go there right now. I'm not doing anything with my long-term investment basket. I'm not that freaked out like, oh, it's this and that. No, so that's a separate topic that that if I covered that, you guys will be sitting here for 8 hours and I'll have to charge you $1,000. I'll definitely cover that on one of these sessions. On my but the quick question answer is that I'm a little bit more cautious, no question about it, but I haven't made any fundamental changes, and I'm looking to add substantially to some of them as this market progresses and corrects a little bit more. So that would be the direct answer to the question.
Thank you.
Yeah, but I'll definitely cover that. So anyway, so going back to it, for active traders, I would say specialize on the SPYs, specialize on the RUTs. You can specialize on trade the Qs, and of course IWM, stuff like that. And of course we have the flip side on the inverse, with the UVXY and stuff like that. One thing I've learned over the years, just sharing something with everyone, if you focus on 5 or 6 different instruments and tools to fight this battle that we fight every day, you don't need to go out there and scan and look. Every time they say, oh, I'm scanning for things, you hear the traders say all the time. Each to its own. I mean, what do you have to scan so much? When you buy something and it's up 40% in 5 minutes, or up 100% in 20 minutes, or up like the puts went from $4 to $28, those SPX, 2040 puts. So what's it to scan so much? To devote your time in managing a set number of tools to attack the market, both on the long and short side, and you will see the fruits of your labor right in the form of that P&L glowing green on the worst week of the market, or at least a worst pullback week of the market. I'm just telling you that right now. So focus on that instead of just looking around to see what stocks might be are going to go do this and that. Sure, but just keep a select basket, specialize in them. Don't be a jack of all trades, master of none. That's the worst thing that traders and investors can do, just so you know. So all right, just had to put that in. So here we are. This is your long-term uptrend from the lows of 2009. Right there, March 9, 2009. I still remember the date. And I'm not going like this because that, if you notice, because this is just one point. So I'm going to touch as many points as possible and go here. So we got 182, right? So let me put the SPX there because I think that'll be easier. One second, please. Somebody's having a big party. Okay, one second here. Personally, I can't wait Monday to start. Okay, this is going to be one heck of a busy week. And I'll certainly do my best to guide everyone as much as possible. So here you have the uptrend line, okay, from 2000 and from 2009, right here, right? Everyone see that? Okay, I'm going to ask one question and I want just one quick answer. Where does one think is the most optimal buying opportunity where you can literally buy big stuff and sit there for 2 or 3 months? At what level?
1804.
Okay.
When it hits that uptrend line.
Keep going, other people. Jack? Jack, you there?
Yeah.
Yeah, where do you think would be the best optimal, like, one of those, like, gift generational buying opportunity for a decent amount of time? At what level do you think that would be?
16.
16. Now, why did you pick 16?
Because it is a breakout level.
Very smart answer. Yeah, so this is the one, right? So this is the reason why you picked it, because that was a big breakout, right?
Mm-hmm.
Okay, 1 second. Let me just put this in actually blue, so it's a striking color. And the other people who have been answered, so that's fine. So the answer is that if you're waiting around for 16, it ain't gonna happen that soon. But that's a good answer, because I've showed that breakout line in my older video casts where I used to do these long-term analysis and stuff like that. So that will happen. That'll happen. But it is not something, just letting you guys know, that you're going to get that easy. Because in life and in trading, nobody's going to hand anything to you on a silver platter. The best trades are the ones where you basically work with what you have in your hands. Why should they make it that easy to be short the market and over the next 6 months we go down to 1558, the breakout level, which automatically generates a significant bounce? It won't happen right away. The first level is what some of the first responses were around this 1800 level. Now do the math here. We are at 1970 right now. Wow, we're back to the Beatles. So so we're at the, and we go down another 170 points. Multiply that with roughly 8, because each S&P point is roughly 8 Dow points. You got another 1360 Dow points, okay? From the level that we closed on thing, it comes to 15,100. Somebody write that down somewhere. So basically, to get down to this level here, which would be a nice significant correction, you are going to basically, and I repeat the word only, need to drop another 1360 points. I'm sorry, another 170 point thing, 170 times, so 15,100. Let's call it 15,000. All right. So the Dow 15,000 mark would be a generational buying opportunity. Of course, when it hits 15,000, you're just not going to hit it there and say, okay, we're moving higher. It's going to slip a little bit more and all that stuff. That's the micro stuff, but that's the bigger stuff. Now, in the meantime, this is the way you want to know what the background picture is going to be. This has always worked for me, so I'm just letting you guys know. So you have this massive breakout, which we will test, and I believe that probably happens by next year. And this generational breakout at this level in April of 2013, let me assure you, you had the most minimal amount of participation and the highest screams of the bears, who kept on saying, no frigging way, this is all garbage, this is not right. And then the final, what do the dogmatic bears always keep on saying? This is not right, it's all going to end really badly. So you keep on hearing these bearish guys, like hardcore guys who are like always bearish. They tell you, I told you this a year ago is going to happen. So what'd you do for a year? Go sit in Somalia and eat beans? I mean, what did you do for a full year? We all traded, we all made some money, the markets went up big time. So when people say, I knew this was coming, well, great. So what do you do in the middle? Just sit there? Because I can't afford to do that. So that's why I laugh when I hear these people say, oh, I knew this was going to happen. Of course, corrective pullbacks are going to happen. Or when there's a massive breakout in the middle of I knew that was going to happen. So those things like I knew they were going to happen and they're a year early makes no money for anybody, just so you guys understand. Unless you're a very long-term manager and you have significant amounts of capital at your disposal, like those short sellers like Jim Chanos. I'm sure you guys know who he is. One of the best short sellers in the world. He'll take a short position and sit and breathe that short position and sometimes suffocate because it's going the other way, but he'll sit there for 2-3 years and then finally make money. Well, he's a frigging billionaire. They're good for him. But the average trader and stuff who wants to make nice large, whatever figures you want to make, okay, on a monthly basis, yearly basis, whatever the case may be. You don't have that luxury. Just wanted to make it very clear. Okay, this is all behavioral game theory stuff. So listening to those guys really makes no money in our pockets. So saying all that, the best way to analyze what's going on here is basically draw another line from this acceleration zone, which I have shown many times. Okay, let's say we do this acceleration zone directly from, I have to get some of these lines out of here. So let me just zoom in 1 second. So we just have a broader roadmap on what's that. And in fact, you know what? I am going to pull this. Mars Mars 99, correct? Mars, you just walked in? Hello?
Hey, it was me, Vix, who just logged off like 5 minutes
Okay.
back and
Who's
internet issue.
No problem, my friend. Mars 99, who's that? I know the person, but
She's typing on the chat.
Hi, Frank. This is. Hi, Frank. Can you hear me? This is Milind.
Millen, did you just walk in?
Yes, I did. Indeed, just 5 minutes back.
Yeah. 1 second. Millen, are you part of the? Are you part? Because I gotta. Okay, whose microphone is that? All right, don't worry about it. Just sit there. So this is so much easier to read. So here you have you see, Think or Swim is such a technical platform and stuff. It's great for trading. It's not very easy when you're trying to analyze things like on a longer term. So here's this picture of the Dow Jones Industrial Average. So the simplest way to look at it is you got this massive channel going from 2008, 2009, right? It can't be any picture perfect. And the bottom line is that at this point, much easier to draw this here. So here you have the 14,000. It's not mine. Okay, so here you have the 14,000 level, right? So this is the way I draw the lines. Very simple. Remember, every single inflection point, whether it be a reversal hammer or whether it be a some sort of spinning top naked bar, people are familiar with that. Those are those ones which is like the long tail with the little head. Okay. 1 second. This is known as a generally speaking, this is called a reversal hammer. So this is obviously the positive one, that type of stuff. So bottom line is, so whether on the reversals, you see one here, pinpoint it, and I'm going to ask people a question here. Actually, I'll say that. If you look at this top here, it's a rounded top, right? But there was no reversal candle. Like it wasn't like, oh my God, we just went up 600 points. Nobody's there to buy, and we crashed. There's none of that like that. So there was no one signal, like a big red candle like this, okay, which said that was the top. Can everyone see that? So you can just just instead of speaking, maybe you can just type in Y on the chat message, okay, on the GoToMeet Citrix online message. So there was no reversal candle of any magnitude to signify that this was that was more of a rounded top that kept on showing for a bit. Anyway, and we have had massive rallies in between that. So here's your picture of the good old Dow Jones. So at this point, you have a major inflection point at 15,000. This was the turnaround point that I have kept on showing for months now. October of last year, where pretty much the same situation. We didn't have a currency crisis, but we certainly have a high yield bond crisis. We had Ebola, we had ISIS. I mean, you name it. I mean, it was just one after another. This was the big correction. So here you have the big one. So at this point, the lower end of the channel, we're getting close, is more like around 16,300. Okay, so you're talking give or take another 100 to 150 points. without getting too exact, but we're getting there. We're getting there. Now, the reason I say we're not there yet, I'll show you on the internals. Very simple stuff to read. This would be a great, this would be a big inflection point here, and this would, from pure pattern symmetry standpoint, you will have beautifully gone ahead and done the pattern. I mean, completed the pattern. Okay. Not that very easy to understand when you look at this. Markets are actually pretty easy when you try to analyze it in 2020 hindsight. So this would be another great buying opportunity, and that would be around a little less than 16,000. Can we get there by this month? We can. Just so you guys know, we can. We might actually complete the cycle the same time that we completed this cycle on October 17. By October, I can almost put money down, which I do every day, that we are going to basically go to 15,830. So you're talking another 1,000 point. Sorry, am I doing this right? Sorry, yeah, 15,870. Okay, 15,008. Let's call it 15,850. So we're talking how many points here? So if it's 15,850, that's 150 plus another 500. So another 600 some points. Put that down somewhere in your head. Write it down. Another 600 points. We get monumental buying opportunity. Now, if we break this, obviously then Jack, as he pointed out very clearly, this massive breakout level, which will, in my opinion, will get completed. Breakouts from a technical standpoint, as I've proven over and over again, breakout levels always, one point or another, over a period of time, get tested. So if we test this, okay, this is the Dow breakout level we're looking at, which is around 14,000 and change. It will be a generational buying opportunity. So it's not going to happen that easy. Anytime there's a generational buying opportunity, like was the case here and stuff, like the case here, it's just, it'll never make it easy, but it's going there, maybe by next year, which is a long time from now. So saying all that, at this point, these are the lines that we're watching. And from this point, I'm going to speed up a little bit. So this is the line that we're watching, and this is your trading band. So if you want to just look at it simply, that's your trading band. Your trading band from this point going out to the end of the year is 15,800 to 18,400. That's 2,400 points, correct? Yes? Can everyone hear me?
Yep.
15,800 to 18,400 or so. All right? Now, I'm making this very clear so that nobody's surprised what happens to the market between now and the end of the year. How about that? I laid the ground for you. So when you see those 400-point drops, sure, fill up the chat room with like, oh my God, I can't believe, wow. It's great, but don't be surprised. Don't be surprised. Another 600-point drop, get used to it. Now, what's going to bring the wow out of me, just so you all know, where I'm going to be like, holy crap, is if we go straight down. If we go straight down like this, that means this breakout level ain't going to hold. That means there's a massive global meltdown. That means we're going to get into recession, hello, a week from now. A global recession. You're talking riots on the streets of China. You're talking riots across the world. You're talking a lot of screams here. Hopefully no crazy riots. But if this goes straight down like that, just so you guys know, that's a monumental breakdown. That means the multi-trillion-dollar money management business is just going boof. And maybe they just basically say, you know what, we're not even give you money on your S&P puts and stuff because you made so much. They'll say, sorry, won't give you. CBOE, Chicago Board of Options Exchange, puts a moratorium like, okay, traders, sorry, man, can't give you the money because you just made too much. And it's possible, believe me, all kinds of crazy stuff can happen. That's only if there's a real direct meltdown here. So that's obviously, catastrophic events, and who knows? I mean, I'm not going to even go there. I don't live in a cave. So the point is, at this point, technically speaking, the force, and this is one thing I want people to understand, that the force and the momentum of this move here within the past week from 17,600 to 16,000. Well, actually, from here, this was the ultimate sell, right? This was the sell where I said just sell or take your profits right after the Fed came out and the market spiked. What day was it? It was Wednesday. It was Wednesday. So, well, this is going Friday by Friday. It was Wednesday, if everyone remembers. Well, they better remember, because when they didn't do that, they got hurt. So, bottom line is that the rapidity of the move is so violent that use normal physics, this is just not going to all of a sudden just reverse that quickly. It can happen. I've seen it happen way too many times. But if you look back at history and look at the size of this candle, can anyone show me if we ever had a candle like this, of this magnitude, in 1 week? I'm going back to 2000. When was the last time we saw a candle of that magnitude? Can anyone point it out? Within this channel I'm talking about.
Maybe in 2011.
Yes.
After June.
Yes. Yeah. Right there. See? But here I have news for you, my friend. As in a 1 week candle, there are none.
Mm-hmm.
This was the worst week. I mean, the size of this candle I'm talking about. Let me get these lines out so we can see this more clearly. Okay. So if we look at this candle right here, the week of October 2008. October of 2008. So, and then we had a violent rally right after that. This here, the zigzag, and then of course it gave in and created the bottom in 2009. Multi-month process from October till March of 2009. It's not something that happened in 1 day, but I want people to realize that the size of this candle is just humongous. Now, there's a reason behind it. You had a complete oil collapse and a commodity collapse on the front, and a significant amount of very large hedge funds blew up their commodity portfolios. Blew up. One of the smartest traders in the world, who made God knows how many billions of dollars over the years, Andy Hall, okay, oil trader. His portfolio, forget about it. And he's smart. Because what's happening with oil is not necessarily just China and this and that. What is it? We're driving less and the rest of the world's driving less? No. It's simply that there is a technical adjustment going on, correction, which is hard. And the reason behind it, that you won't hear from any other service, is because there are so many complicated, complex strategies and products, as in derivatives, okay? More global players using more derivatives, options, hedges, this and that when it starts to unravel, it creates an avalanche. Does everyone understand that concept?
Yes.
Because one of the things about my service is you're never going to hear the same old crap that you hear from other people. I'm telling you the way I see it. Am I right? I don't know. It's worked for me. This is the way I look into it. Not just the markets, but overall. This is pure, hardcore, real economics, all right? Macroeconomics, Freakonomics. Go listen to that CD. So the book, read the book. So the point is, everything applies to our life. So because of these complex derivatives and strategies that are all in place, and the larger amount of money that bet on oil because of the shale oil revolution and stuff within our economy, which is still alive, by the way, you had a massive meltdown. So then you had the China slowdown, which accelerated it. So this type of candle you see when they literally, this is the visual representation of your entire net worth blowing up. That's what happened to a whole bunch of smaller hedge funds and other commodity players out there. All right. So this is the visual representation of it. You'd never want to be in there. And that's obviously for the guys who basically just like to shove everything in there, and the BTMFD type of crowd. Okay, so let them blow up. So that's what happened. Okay, so this is it. So at this point, we should get a bounce at around the 60, give or take another 100 to 200 points we are getting ready for a significant bounce. Simple way to read it. Let's keep this simple. We have the 34 and the 50-day moving average. I've said it before. We won't know if this is the real turn and its onset of a multi-year bear market till we have had a convincing cross, not just a fake cross. We have had a cross here, a cross of the 34 and the 50 here. We have had a cross of the 34 and the 50 here, minor crosses, okay? And through all these corrections, the 50 and the 34 has always had a gaping spread, or the spread has still been positive. It's a positive spread, and it continues. So even after this drop here, want to show this to everyone so everyone's clear about this, okay? Is the fact that you have it is still widening. So over a period of 6-7 months, that's when you'll see. This doesn't change in one day, by the way. This is a weekly, multi-year moving average. So over the time that you start to see this, that's when you can basically say we are in a real bear market. And by the time technicians realize it's a bear market, it's over. Just the way economists have predicted 9 out of the last 3 recessions. You know that running joke? By the time they say we're in a recession, the recession's almost out of the way. It's just the way things work. So bottom line is what I do as a trader, as an investor, I look to see how many rejections you get as this line is turning down. Can anyone tell me quickly what I meant by saying that? Let me make this clean. When I say that, the way I decide whether or not it is sell every single major rally, or whether or not or whether or not you do the opposite, which is buy every single major dip. When I say that I monitor, of course I'll be monitoring on a shorter term basis, the rejection. What rejection am I talking about?
When the 50 is on top of the 34.
No. Anyone else?
The price fails to go above the moving average.
Thank you, sir. In other words, the rejection of having massive rallies, but it fails on the downward sloping, hits the downward sloping 50 and the 34, and keeps on doing this. Is everyone clear on that?
A lower high.
Yep, all that builds into that. You know, a lower high, exactly. So you can draw a trend line. I like the moving averages because they're very reliable. Because moving averages don't lie. Technicians lie, investors lie, traders lie all the time. Okay, Wall Street lies all the time. So the bottom line is that moving averages never lie. They're just the moving aggregate of your averages over the prices. So this is the best way to read it. So that would be the case of knowing that. But that's too far ahead to look at. So let's look at the daily here. The daily here, and let's do some real work as to where we're going to make the money. So this is the daily on the Dow Jones Industrial Average. Wow, look at that. Whoosh. So this would be a perfect scenario, right? A perfect scenario would be another 650 points, correct? And I think we get that either right away, just looking at the structure of this pattern, or we get it by October. Now, if people remember, I know Guru does, and Vix and you guys probably do, that I talked about the fact that that this was one of the biggest, I've talked about it quite often, one of the biggest generational buying opportunities where we went up literally 2,000 points in a matter of a month and a half. Okay, and this was the December drop, and this was the December rise. So I've always said this, and I repeat it again. So if we look at pattern symmetry, if we rose like this as we did, then why can we fall like this? Don't be surprised. Don't be surprised. It's just the exact pattern. And in between, Chop, chop, chop. Lots of money to be made. It's beautiful. So, Derek, you still there? DW, you still there?
Yeah, I'm here.
Okay.
Yeah, I'm here.
Yeah. Some of this making sense?
Yep.
Sounds good. I always kid around with DW. We chat sometimes during the day, so I'm always busting his chops, so he knows that. But all in good fun. And he busts my chops too, by the way. So I gotta give him that. So all right. So this is it. So the what when I look at this and I'm seeing this here, I'll tell you guys, I think we're gonna go here, and I'm gonna like real fast. It might happen this month because at this point I can't find any technical basis to say on a daily basis, mind you. Just bear with me one sec. Okay, you guys there?
Yep.
So you heard it here first, okay? I have no technical basis looking at this chart on a daily, just like all of you people out there, to make a case that we're not going there. You know, because it's just straight hammered down. It's straight out. So what? So the beauty about the thing is that whatever we do, and Vix and these guys were pretty active, you know, remember that. We have to have a hedge in between our long positions every single day, almost. Okay? Because if we don't have that hedge via the vehicles that we use, the tools that we use, then we don't know what we are waking up to the next morning or in the middle of the night when I'm checking my stuff. Okay? Unless we completely turn into futures traders, in which case I don't want to be up in the middle of the night. Actually, futures trading is fantastic. I did that for a bit. I might restart again. But then I'll be so sleepy during the day, you guys wouldn't even find me. You know what I'm saying? And I close out my positions at, before the market opens, and I'll say, VIX, run the show. So, all right. So saying all this, this is exciting to me. It's exciting in the sense that we actually have a direction, and the direction for now is down. Now, when this happened, nobody could believe it. I remember I called the reversal hammer, all that stuff, and I did really well on this run. Then I said, whoa, this is big. You know, so I kept on going, you know, taking smaller positions, and it did really well on this run. But imagine if and I repeat that, a $10,000 investment here on the option side, on the pure calls, on the indices, you know, forget the stocks, would have generated more than $100,000 to $200,000 right here. I'm not kidding. Now, did I know that I was obviously playing with, bigger than that, starting off here. I got very aggressive at this point when I saw what was going on. And of course I measured what was going on back here. So it wasn't just looking at this. But things were just extremely oversold and all kinds of stuff, what was going on. So, but I didn't hold what I initially bought here all the way up here. I staggered my way up. Most people couldn't believe what was going on. So they mostly came in here. Some of them make a little bit of money. And then came this. So my point is that now that we are repeating that move here, is it too late to short the market? Nope. Is it a one-way bet that it's going to go there? Nope. Because on shorter time frame, as we all know by now, on the 1 hour, which we'll quickly look at, on the 60 minute, I mean the 1 hour, 60 minute, the 4 hour, and different time frames you're looking at, it will zigzag its way up. Just the way this zigzagged its way up, it's and just the way this zigzag, and you had these big, down days and stuff. Well, this will be the same way, same pattern symmetry. I'm telling you right now. Then there'll be little rallies. Don't get excited by them. Just the way there were little drops here and everyone got shit scared. Excuse my French, sorry. Everyone got really scared, terrified. Oh my God, you know, this is moving so fast. It's just going to crash and burn, right? So nobody really like got into it. It's the same thing going to happen here. Don't get excited by cheaper prices. Prices are getting cheaper. And then, so whatever mini rallies and stuff that we have intraday, they're sellable events for now, till we get down here. Is it that simple? In a way it is. Either that, I'm just like, you know, so that's what's going to happen. So little rallies that you see, and I'm going to be playing them. Oh boy, I'm going to be playing them back and forth. So, but don't try to over trade, because you know what happens to traders, right? You do very well in 2 or 3 trades and you give back all of it because you did the last 3 at the end of the day. That's what I was idiotically doing on Thursday. So my voice is echoing, so somebody mute the phone. So on Thursday, when I did extremely well with on Wednesday, you know, with selling chunk of the Fed spike, you know, the pump and dump spike, as I called it. And then Thursday, I like tooling around. So yeah, it was a small thing, but I gave back about 3 to 4% of my winnings, which is pretty big on Wednesday. So 3 to 4% was pretty big too. Not that it mattered. I kept most of it. And then at the latter part of the day, I did the puts. And those puts went from $4 to $28 at the open. All right. And there was cash settled. So basically they settled them on the other side. So, but people who did the puts obviously did the same thing. I didn't know that the market was going to, you know, do that crazy stuff the next day. So again, what I was trying to say was, because I was kind of pushing and forcing trades here and there, like sometimes just sit back, do one or two tactical trades. So in between minor rallies and stuff, we're going to land up here. Is that clear with everyone?
Yes.
There you go. So when you read all those articles and they say, oh, the sell-off is not over and this and that, they're never giving you a thing. What amazes me is that in some cases things are so simple to look at, and yet you never hear it from these guys. But who cares? You know. So you have this level here, 17,000. Natural magnet is to get back to 17,000. So it's possible, just so you know, it is possible that this is one scenario, high probability scenario, but it is also possible, given the nature and the violence of the selling. And like they say in life, when it gets too easy, get out of Dodge. If it gets too easy short in the market, you can rest assured they'll burn you. The machines will burn you. So the bottom line is, the other scenario is that they make a violent attempt, a 500-point rally towards 17,000, and of course rejection at this. That to me, unless this line's turn, you're going to be rejected. Okay, so a violent rally up here, maybe an overshoot that things are really crazy. And you know why that'll happen? One night when you're sleeping, you're going to see this tweety on my real-time Twitter feed. China releases massive economic numbers because something good happened. And they didn't make it up this time. Like something really good happened. All right? And the next thing you know, the markets, the shorts are all hell-bent on, somebody mute their microphone, hell-bent on just shorting really hard here, and there'll be a 500-point rally. Because now this is becoming too obvious. Remember, in the market, when something becomes too obvious, it doesn't work. Period. So you're getting a lot of excitement from the hardcore bears. Just look on StockTwits. They're posting pictures of slain bulls and you name it. Everyone thinks they're a freaking genius because after almost a year they made some money. So bottom line is that so that's the other scenario. A failure here is possible, but this needs to get tested one way or the other. Now, it is possible that we never get there. We'll see what happens. Let's look at some internals very quickly. Daily chart of the Dow Jones. Is this telling you? I want a clear answer from each one of you. Start off with Sherry. Does this, the basic stochastics, is it telling you that we are oversold?
Yes.
Wrong. I already gave the answer. All right. We're not oversold yet. You get some major oversold conditions, generally speaking. We are oversold on a short-term basis. I'm talking daily. So you're right. Is when you get this line, the directional 5 line, to come down towards this level, and you start to see a move. This one has to get into the deep negative. It is in the deep negative right now, but this is so basically as in confirmation of oversold. Another 400-500 points, you're going to see deep positions. And let me show you just visual stuff, right? So October, 1 second. This was October. See how deep it got? These are nice.
Yes.
These are nice. But you could be dead right, because the volatility algos are so fast and so quick. They can get this oversold and stuff in give or take half an hour. They can do that. I've seen that happen all the time. And people are like wondering, hey, what's going on? He's coming up with this, now he's coming up with it. Because I'm watching those stochastics on Thinkorswim and my other platforms, and they're just boom, within like minutes, they're over that it's back there and starting to turn. So I changed direction. But aside from that, this is the most obvious point. So that's a high probability trade, but everyone thinks that's what's going to happen. I'm thinking even it's going to happen, so maybe it doesn't happen. Okay, it made it, and of course we are well below the acceleration band. And you know what? We are very far from the standard deviation is almost 3 here. Okay, from the 34 and the 50-day moving average, reversion to the mean, biggest money maker always for swing traders. So first level is 17,000, which is also trying to get back inside this acceleration band, the green line. Let me put the Bollinger Band out there. On second. And I'm purposely keeping this simple so everyone can see this, okay? Not because you guys won't understand. There's a lot of other complicated technicals I can show you and stuff, but I'm purposely keeping it simple because that's exactly the way it's going to work. I'm telling you right now. So there's no point in getting into too many technical dynamics, then you'll lose sight of the bigger picture. So this is the breakdown level, straight through. We overshot the Bollinger. Whoa, I haven't seen that in a long time. Anytime you overshoot the Bollinger out like that, you get in. But I can't even think of a time when we overshot the Bollinger to that degree. Let me see if there is a 1 second. There is a wow, Bollinger bandwidth. I never really look at this one, but just keep in mind that yeah, this is I just saw something here. Okay, so you get, in other words, we are getting very extreme. But just because we're getting very extreme doesn't mean Monday is going to be the turnaround day. Just remember that it could be Tuesday, but there's a big one coming next week, as in the form of a massive rally. So here, I also look at the vortex indicator. Very quick visual.
Clue.
Yes, go ahead.
Derek here. So if we look at, I'm looking back when you showed this where it broke the Bollinger. If I'm looking at that, so we should technically then potentially have a rally as early as Monday, Tuesday. Is that kind of what you're seeing or thinking?
Yeah, well, that's what I said. I don't know if it's going to start off on Monday because there are still a large, because the fear, you're going to look at the two components, subcomponents, okay, of this whole technical stuff. One is the emotional subcomponent.
Okay.
There is massive panic. Okay, so massive panic, just like any other manic depressive thing, it doesn't turn in one day. Okay, so that will take, but I'm assuming, so that's one component. The other component is the technical component, as in the administrative stuff that needs to be taken care of, which is margins. There has been huge margin calls that need to be met. Anybody who's I know Mary knows, but you guys who has played margin knows that they give you 3 days. It's trade date plus 3, T plus 3. Okay, so if we take into account that we started breaking down on the 20th, it's 3 business days. So so they give you 5. You have 5 business days from the 20th, which brings it to what?
The 25th.
So 25th was 1. Okay. So 1 second. No, it wasn't 25th. This happened.
Oh, the weekends, I don't think they count.
Yeah, they don't count the weekend. So the point is, like, if you look at the most recent breakdown, which started on the 18th, this is the best way to do it. All right. Somebody give me exactly 5 days from the 18th. What day is it? And I'm not talking the 23rd. I'll fail you on that. I'm talking without the, I'm looking at the calendar without the weekends and holidays. Let me see here. I'll give it to you right now. 1, 2, 3, 4, 5. 25th. So Derek might be 110% correct. Like I said, Tuesdays are generally turnaround days. By the 25th, you should expect to see the selling pressure abate. All right. So any rallies on Monday and stuff need to be shorted because they will be using those rallies to sell. When you see some stocks like pop up $15 and they completely give everything back, you're like, oh, what's going on? Well, what's going on is they're using that as currency to sell. When margin clerks are not stupid. They have a book there, especially institutional margin clerks. Let's say a position of. Okay, somebody please mute me. All right. So the thing is, let's say they have a 10,000 share position of Apple, and the thing goes up in $3-4. That's extra 40,000 they just got for not doing much. So they go ahead and sell that right away. So between that and hedge fund day traders, you get massive volatility. And you wonder why they keep, why they do that. So given the fact that we are right now in demolition derby mode, there is going to be large amounts of margin calls on average mutual funds also, not just hedge funds, because this hit everything. I mean, Mickey got swiped again. You don't think there's margin calls on Mickey right now on Disney? A lot. So you are basically, this is a broad-based stuff. That's why I'm saying the possibility of hitting it here is rather quick. So these margin pressure has to abate because this has nothing to do with market fundamentals. And Derek, I want you to understand that. This has nothing to do with market fundamentals. It simply has to do with money management and maintenance. Okay? They need to cover those calls and in order to have the selling pressure abate. Am I clear with everyone on that? Yes? Okay, good. Now, if I do this, do my simple stuff, which has always worked, honestly speaking. This was the line we were looking at. So that's a see you later line. So you can do all kinds of different analysis. I can draw this was the downtrend line, which we kept on, this was the first tell that we wouldn't be going higher. Okay, then you can do this. This channel was broken. So give or take Tuesday, Wednesday, yeah. Now remember one thing here. I want everyone to, when is Labor Day weekend? It's September 4th, right? I mean, September 4th? 7th, right? When's Labor Day weekend? September 4th, right?
Yeah, right.
Right. I can bet you, and I've been right on this 100% of the time over the years, you're not going to see a massive sell-off that particular week going into the weekend, Labor Day weekend. Okay? That's purely for economic reasons. People who followed me know that very well. You're not going to see people completely depressed and basically falling over their barbecues and saying that's it, I'm not going to Best Buy to buy, electronics or, retailers and stuff like that. You're not going to do that. That's going to throw the country into a, it's a huge shopping weekend, huge discount weekend. And so whichever the case, you should get a strong week that particular week, just so you know that. So technically we are out there on the daily. At this point, like I said, started this seminar by saying that technicals carry lesser weight because things are just out of control right now. So got to follow very closely what I'm doing during the day. I do not intend to change my mind every 5 minutes. I am just like any other trader out there, adapting very quickly. So I'll be looking at a lot of things, but you have to follow what I'm saying. Don't need to take every trade and stuff that I'm putting out there. Don't have to do that, but at least get the gist of what I'm putting out there across. So that's your daily stuff. Now, if you look at the if you look at, oh, let me see one thing here, which I haven't had a chance to see before I started this session, which is the Kappa curve. And I've showed this a couple of times. This is a directional indicator for the markets. You want to know what exactly it is. It's a long-term directional indicator, and it has worked very well for large trend changes. So at this point in time, it is basically on the lower end of the scale from what I can see. Okay, and please do read the definition of the Kappa curve on Investopedia. So every single time the Kappa has come down here, right, aside from this October low, it is, this is the best buying opportunity regardless of anything, regardless of what, just from a technical standpoint, right? So we are not fully there yet. We were there in last October. So if we don't get here right away, we're going to get here in October or September. So the Kappa down here at -10 or -8, you can put this on your screens too, at -8 is the ultimate buy signal. All right, ultimate buy signal. So use that too. On a short-term basis, let's look at the hourly, which matters to traders. It is the market is certainly stretching hard, very oversold, but then oversold can remain oversold, and we are seeing extreme conditions on the what do you call it, on the VI negative, but that doesn't mean it can't shoot higher. We saw what happened to the VIX. Man, I really.
I have
Yeah.
a question about that curve that you just showed.
Which
you
one?
said it shows the Kappa curve.
Yeah, it's mainly for monthly, daily, yearly, that type of stuff. Yeah.
Well, my question is, you said it shows trend change. Is that based on accumulation and distribution?
That's why I said look up the definition. It's
Okay.
it's a guy. I don't know. I don't know if he's alive or not. But it is look it up though, because I can't remember exactly. But he uses some weird functions, you know.
Okay.
And it's been, if you look on the weekly, you start to see. Look, when the Kappa was indicating. Let me get these things here. Yeah, I'm sure it takes into account that. This on the weekly basis, honestly speaking, is telling us. It's clearly telling me that we are not all of a sudden going to turn. Every time I've said that, it's done it. But what I'm basically saying is that the Kappa, as we discussed, that we might have to come down and test this 14,000 level, 14,240, which is only about 2,000 plus points from here, in order for the Kappa to reach this type of definitive bottom for another major multi-month rally. You get it? It's at -20. So the Kappa is something very interesting, So right here, we are right here now. The shape of the curve, the way it's showing that we can very easily slip. That's why I said that this move here to 15,800 is almost a given. It will happen. If it doesn't happen, well, what's new? My thing is, so the Kappa basically also tells you this stuff on a multi-year basis. When we had the great 2009 thing, look where the Kappa was. It was at -50, and since this whole bull trend, it has stuck at -20 on its worst extremes. We're at -8.7 right now. You get it? So I still think we get here. That would be the big flush out before the next 2-year bull market starts. And for that to happen, you would need to come down to about 14,000. Is that clear with everyone? So that's just so you know,
Yes.
the bigger picture. Let's look at some smaller pictures on things where we can make some decent money. And then I'll look at a couple of let's look at the VIX, our good friend VIX here. I mean, this is unheard of. But then, hey, these days you hear a lot of things. So I kept on showing this danger zone, all that stuff. I mean, it just bang, just happened. I mean, so I kept on showing this chart. Jack, how long have you been a member?
Around a month or two.
Okay, good. So you're getting used to some of my style of how I do things, right? And
Yeah.
the charts and stuff. Good. Okay, just wanted to add.
Yeah, okay.
So, okay, so it's a little bit different than what people are used to, And I'm not saying good or bad, but I kind of laid down. So these things you don't see. It went to the top of the Bollinger, and it just used that as a pivot. I mean, that is out of control. So like I said, it all ties in. Big commodity funds blew up. Period. Done. From here to Russia. Because this doesn't happen. I mean, I can't think of one time, where it even blew. It used this as a pivot. Not even bothering to come in there. So at this point, it looks very likely that it wants to get and test 30 to 31. So VIX 30 to 31 would be a powerful, Derek, you asked me, I think you might have asked me the VIX one time, would be a very powerful tradable market bottom, which correlates with the 15,875 that I just talked about. Gotcha? So it's all going to fix in this way. At this point, people say, oh, well, it's out of the Bollinger and stuff, so it can pull back. Sure, it can. Absolutely, it can. No question about it. And let me look at the hourly. Hourly, we did see, by the way, at 2 o'clock, there was this quick reversal candle. And I even showed that. I said if it broke below 2250, I was looking at this number here, 2250, gave it a little bit of room. Like if it break below that, then we would have, if we break below that, then we would have a nice market rally. Didn't even bother because it was too much pressure. Now here's the contrarian way of looking at it. It is possible.
On the daily VIX, it also showed it was overbought.
Remember, it's beyond overbought right now. This is just yeah. I mean, it's beyond overbought. I mean, it's getting, it's up there. It's, this is one of the highest overbought levels. But like I say, in extreme conditions, both emotionally and tactically, these things don't matter anymore. That's why looking at the hourly. Now, here is one thing I want to put something across to everyone. So anyway, the 2250 didn't happen. Here is one thing, and I know most of you, and I'm not here to change the way you think, but this is the way I think. It is very possible, having worked in the business for a long time, on the institutional side too, that they wanted to flush out and the institutional margin calls by this weekend. It is very possible. Not because they're scared what will happen on Monday, but they just wanted to get it done. In other words, get the dirty laundry out there and shove it in the washing machine instead of piling it up. Does everyone understand what I just said?
Yes.
In other words, they just wanted to, the large institutional margin clerks, and don't let the clerk fool you. They get paid, $1 million on the upside, when they're the top ones. One of my neighbors was one of them, great guy, for UBS Payne Weber. They are the guard keepers of portfolio sanity, okay? Because they don't want to go upside down. Who takes the loss if somebody doesn't pay the margin? Who takes the loss when somebody doesn't pay them their margin calls? Who takes the loss? I want an answer.
The brokerage.
Thank you. Brokerages are not in the business of taking losses. So they'll sell you out. If you have anything in your portfolio, they'll take the whole frigging thing and sell you out. The online services do that like randomly. The actual wealth management companies, the Goldman Sachs and all those companies, JP Morgan, those guys, obviously talk to you first. You get one phone call. So that's what I'm saying. So it is possible that they decided to just blow everything out quickly. And that's why we had such an extreme condition over 48 hours, which in my opinion is good because they flushed it out. It killed the charts. Technicians are like, oh, it's a death cross. Now it's a double death cross. How do you die twice? And then, it's just like they'll come up with everything. Technicals don't matter in situations like the last 48 hours. That's what I want to make clear. Just the way on the upside with the VIX and on the downside on that, because we are really up there. Whatever the case, just like the stock, which are way below the 50 and the 34-day moving average, this shall also pull back. What's the pullback? Pretty clear. Can pull back to 22, and it can pull back to where it totally broke out of, which is, sorry, let me get all these lines out.
Was the VIX ever higher, or is this a record?
No, VIX has been at 40.
Oh.
Yeah, 1 second. It's a very good question. 1 second. I want to just,
Wow.
It was at 87 actually. One sec.
Wow.
Oh yeah. Let me just get these out. So good question you asked. So when was this at 87? October 2008. You know, October 2008. And then the VIX started to come down, and we didn't bottom till 2009. Okay. So we didn't bottom till here, just so you know, guys. We didn't bottom till here. Closest date I can get, 6th of March. But that big collapse on October, you can look back on the charts, VIX went to 87. So if you're really looking to see from just purely without using technicals where the VIX can go, the VIX has now broken out on a technical basis. All right. So the next level for the VIX, just pure simple stuff here, can be 50. Okay. And that would be VIX, that maybe could be the 700-point drop. Is it possible? Technically it is. All right. So I don't know exactly. No, I'm not a VIX expert as such. But what I'm saying is that when you look at the Bollingers and things to see a level of sanity, what the broad trading levels are, you can clearly see here that the Bollinger that it will come down and retest the broken downtrend. We all know that it's going to do that. So VIX 23 is the logical pullback. VIX 23, I repeat, is the logical pullback, guys. All right. And I don't think it's going below 23. I think we have entered a new zone here of volatility where the VIX is going to trade between 20. You know how the VIX was trading between 10 and 15 for very long? So now the next trading band for the VIX is, honestly, in my opinion, is going to be like 20 to 30, 20 to 30, and then 30 to 40. 30 to 40 is very high, so I'm not going to go there. I would say 20 to 30 is going to be the next trading range for the VIX. All right? It's not that hard to understand. We were trading between 12 and 20. We're trading between 12 and 20 for a while here. So that's it. And if we break above, the VIX breaks over 32, confirmed pullback all the way to 15,000 on the markets. Just so you guys are aware of that. Oh, 15,000, we already looked at it. So that can happen. And this VIX 50 can happen by October, just so you know that. So all those are in place. So you know the broader picture now. So now when we revisit the charts and everything, whether we look at Apple and somebody says, oh man, where can it go? Actually, again, just keep on looking. I mean, I use Fibonacci's, I use breakout levels, I use all kinds of levels. And one sec. So if you look at, very simple, Apple here at 10, Apple here. So on a weekly multi-year basis, Apple 50% retracements are standard. What is 50% retracement on Apple? That's very scary. $72. It's not going to happen right away. But the breakout level is going to be the first level of defense. Apple's going to 100 and slip below 100 quickly. What's 5 points? Nothing. Okay, it doesn't even change the long-term direction of Apple. If somebody wants to bet that that Apple's long-term directional lines are going to change completely downwards, I'll say they're stupid, like really stupid, because they don't understand that Apple, regardless of all the fundamentals and all that stuff, it's a cherished company. They're not going to let America's finest company, which pays the fattest amount of dividends, sitting on the largest amount of cash, to all of a sudden become a bear market toy. They are not going to let it happen that easily. So bears can show me all kinds of beautiful, technical thing, this and that. I don't think Apple's ready for that. If they just increase the dividend by another 5%, which they can do, the stock's going to go up 10% in one day. So what's the big deal? So the breakout levels and stuff, yeah, that's fine. You're going to come to this congestion zone. So it could be like 95, this and that. But as in a full-scale blowout, no. I think Twitter is a screaming buy. I mean, really, whichever. I mean, what's $1 or $2 if it moves, up or down? I think this one it's going to be a huge money maker. Amazon is Amazon. All this is systematic selling. Let's look at the weekly. Amazon could come, The Chinese chopstick pattern. That's when we made it real decent sum of money. So this is a straight down, blow off thing. So first level would be here, 452. Like I'm talking about swing stuff. Do I have the what to short it all the way to 452 by the puts? I might, given where we are. Oh no, this is a weekly. Forget it. The daily, engagement with the 50-day moving average at 482, possible. I think very doable. So this would be a good short. You can buy some puts out there at 490. Give yourself some cushion. Does it all of a sudden turn around and go like that? Tough. I don't think so. I think it needs to complete this. These pullbacks. Netflix. One sec. Let me get all the lines out. Just going through some of the big ones so people understand that. Netflix on the daily is doing a beautiful job of resetting. Okay, we're almost there, not quite. So you can look at this gap here. There's a minor gap here. That's around 96. So I would be a heavy buyer of Netflix in the 90s. I'll let you guys know that. All right. So right now, it's getting there. It's getting there. Price line, demolition derby. Let me see here on the daily. It is basically just re-engaged with the 50 and the moving average. At the end of the day, some people comment, oh my God, it's up $20 in the last 5 minutes. Do you remember that? Do people remember that? Some of the people in the chat room, do you remember? Hello?
I never traded Priceline.
No, I'm not. I'm talking about the guys who do this stuff. Who trade. Do you remember the last 5 minutes? Like Scott comes in and he goes, "Oh my God, it's up $20 in 3 minutes." Guru, can everyone hear me?
Yeah. I didn't see that message.
Okay. Can anyone explain to me why that happened? Please let me ask somebody new. Derek, I'm going to so just so you learn. So it's part of the learning thing. Is why do you think that happened? In literally 2 minutes, it went up $20 in the midst of a 530 point drop in the market.
Honestly, I don't know.
Okay,
I think I know why.
Don't say
Short
it yet.
covering.
1 second. Well, that's the obvious reason. It's a short covering. Well, why the short covering? Let me explain that to you. It re-engaged with the 50 and the 34-day moving average. Anytime a major stocks re-engages with the 50 and 34-day moving average, the first reflex action is boom, bounce off there. Why? Because some bears who shorted Priceline at the highs, okay, because they missed out on this huge move up, they shorted it there, betting on pure technicals that it always comes down to the 50 and the 34-day moving average, which is still rising, by the way. It's also the bottom of the channel. That's the reason why the computer's algos, not humans, automatically started to cover the shorts and the stock jumped within seconds, $20, $25. Is everyone clear on that?
Yes.
That's it. That's the answer. All right, that's just the answer. I actually didn't know the answer till I saw the chart right now. I'm like, okay, that's why it happened. Now, it did not mean that it couldn't have slipped down to the lower end of the Bollinger. Sure, it could have. It's still not fully oversold, if you ask me. I think that bounce is going to get faded. So, but doesn't matter. The minute you have you have the short automatic, the sell stop out there, or short limit out there. So you're going to hit it, boom, you get done. You don't even know it's going on, right? Sometimes it happens when I put trades out there. I don't even know. It just hits it, it goes. So that's pretty much what happened with this. So that's one of the reasons. Anyway, so guys, if anyone has any type of quick question, if I can answer it, I'll entertain it, but I need to start wrapping up. So so let me ask somebody, chat question.
Not much actually.
Okay. I hope that this was a little bit helpful.
Yep.
I thought it was very helpful.
Yeah, I mean, like I said, there's no, we can sit here and, I'm trying to cover a lot of very difficult topics and stuff like within an hour. So I'm still putting out because I don't want to put the fluff out there. This is the reality of what's going on. What I did show very clearly to you guys that don't be surprised by the market going down another 600 points. That's one of the things, key takeaways from this session. Don't be surprised. It's not the end of the world. technically that's where we're going. So that's
So basically at this point, sorry to cut you off, but at this point,
no.
I guess not a good idea to be going long.
If you look at it purely from that basis, and if that scenario comes right, you're correct. But here is the thing with the stock market. Not everything moves at the same time. So you will have individual opportunities, which I'm always trying to identify, like the ACI and stuff I gave you, okay? That ACI, which we talked about, okay, is up 110% from the time that I showed it to you. So if somebody says, oh, the market's down 1,000 points, that stock is up, 110%, what the hell happened? Well, that's the market. There'll always be selective opportunities which are already overpriced, overblown, oversold. So they'll move. So that is a generalized question, and mine was a generalized answer. But when it comes to selectivity, you can still make money on stocks. You'll see green on the screen. I have never had a situation on my side. Yeah, you can go long. You can go long the inverse ETFs like the UVXY. You can go long the what do you call it? You can go long EDZ, for example. Okay, so you can go long Yang, which is the direction shares. These are all inverse ETFs. Trading fund China, right? The inverse of China. So you can always go the inverse if you believe if the market's going down. So it's not like you can't go long things. There's always things you can go long. As in individual stocks, yes, there'll be selective situations which will go higher. These EOGs of the world and stuff which are getting creamed, they will bounce really hard. Every time I bought it in the 70s, it's gone to 80s. So
what would make you change your mind to think we're going into a bear market?
I told you. I don't know. I mean, what's going to change my mind? That fundamental deterioration in central bank policy shift, which is not happening. In other words, when you drain the swamp of the money, of liquidity, that what causes bear markets. The other thing that it would fundamentally shift my idea that, economically speaking, is a massive downturn in the U.S. housing market. Because if the U.S. housing market, which is a pillar of global growth, forget about U.S. growth, it puts in so much money and such a driver of the U.S. economy, which affects all other economies out there. When we sneeze, they get a flu. All right. So one of the easiest answers to you, Sherry, if you see a big downturn in the U.S. housing market, we're going into a global recession. Simple.
I have to tell you, I travel a lot, and wherever I'm traveling, all I see is building, building, building.
Correct. And if you travel, and as people travel overseas, they're doing the same thing. That's the reason dogmatic bears never make real money, because they always think that the world is always going into a recession. I've always said this, and I'll stick to it. Human existence is the story of a bull market. You wake up in the morning thinking you're going to be alive, not dead. So, we want to look at it from a philosophical standpoint. From a technical standpoint, corrective, yes, those are big corrections. But you can get them screaming out there, the world is falling apart. And in 9/11, I almost died. It wasn't even a bear market. The market went down for 1 week. All right? And talk about depression. You think this was bad. Holy shit. Even I was like freaked out. Not scared. I was just so sad. All right? So that's what I'm saying. So in that context, no. The bull is not dead, but it needs to correct. Excesses need to be wrung out of certain asset classes, like junk bonds and stuff like that. That's what you're seeing right now. Okay? Global growth slows down in a massive way, and our economy, housing and everything goes down. Then you have a multi-year bear market in the making. But we won't know that till 2 years down the road. Just so you know that. Okay. Any other quick question?
So on Monday morning, what do we actually look for? Because I have some SPX and RUT calls open. Do I take book the loss or hold it and wait till Tuesday for the?
Here's my answer to your question. Tell me what's going to happen on Monday morning. I'll give you the answer. I'm serious. You know what I'm saying? I mean, we could have a frigging 100 points up on Monday morning. In my opinion, the RUT calls don't expire till next week, right?
Yeah, till Thursday, right?
Okay, yeah, and I bought some at the close too. So this is what I would do it. I can walk you through it. This is what I would do it. I would basically sit there, watch the market. If we're down like another 300 points, we're getting close to our inflection point, right? I would basically cost average. I always cost average. I generally don't like cost averaging on the way up. Sometimes I do, but I love cost averaging on the way down during volatility. All right. So I would basically sit back, actually pray for a 400-point drop on Monday, scale in, buy a little bit, and sell the crap out of it by Tuesday afternoon as we rally.
Okay.
FCX, you're fine with that. You're fine with that. That's a swing. Okay. So that's the answer to the question. That's the way we got to do each of the trades. That if we do have it and we do get a big slam down, remember one thing. After what we went through this week, it's unlikely we're going to repeat it right away next week. Even though I showed you that we're going to go to those levels. You get what I'm saying? There'll be a sigh of, yeah, we're not going to get the double unless we're going into a massive meltdown, which could happen. It could be like, October 19, 1987, where the market just opens up and closes because they can't, if it falls below a certain point, 500 points, I mean, not 500, what is it, 700 points, triggers off. It's a different story. Aside from that, I don't expect an immediate repeat of this week. So that's all I'm saying. All right?
Okay.
Okay. So we're good, everyone?
So just one more thing. So if we had another real big pullback on Monday, what would be in your mind, what would be the best ETF? Would it be like a UVXY to be buying that, or what do you think?
You just got it wrong. UVXY is when you buy before the big pullbacks, because that's an invert. No, the other one is the SVXY.
SVXY.
Okay. SVXY. Yes. So those would be fantastic. You can buy the TNA, which is the Russell 2001, and so those would be the ones which would be buy. So on a major pullback, and the best ones, honestly, with oil, it started to, believe me, oil, it's starting to stabilize. In fact, it was up over 40 right at the close. And I noticed one side of my screen where I saw these stocks, like, a couple of long-term holdings that I have, like Bluebird Bio, Blue was up like $4. So when you look at it, overall damage in the market, it was more concentrated on the big name, high momentum tech stocks rather than on the biotechs, believe it or not. Even though one of the big biotechs I like a lot, Regeneron, was down 18 after being up. There are pockets of these strengths, and I'll try to highlight the ones which selectively are holding out very, very well. So it's not like a mass scale stuff, but okay.
So big pullback, then you would be getting into the SVXY or TNA?
Those are the ones, and our friend Richard Hager knows quite a few of the other ones that we can ask him for.
Yeah, okay. Perfect.
Okay. So 1 second, this it would be good to say. So Guru, you still there?
Thank you. I've got to catch a plane.
Yeah, running along. Listen, have a safe flight, Sherry. I'll talk to you. Have a safe flight.
Thank you.
Yeah.
Thank you. Bye-bye.
Guru, you still there?
Yeah, I'm here.
Yeah. So I got your feedback on that. Yes, I'll do that next time. Okay. I just didn't have time for this one on that. Yep. High yield, correlate. Next session, what we'll do, we'll talk about correlation between different proxies that I'm looking at as I'm making a determination on the market. All right, and we'll completely do that, all technicals. Fair enough?
Yep.
Yeah,
okay, and I might be doing a session in the middle of the week too, depending on that, so that people can join in. We don't have to wait till again next Saturday. All right. Okay, so let me run. And some of the newer people who joined us today, feel free to leave some feedback on the testimonial section. Good, bad, doesn't matter. Certainly like to hear on that, and let's stay involved. And like I said, one with the other, we're gonna be okay next week. We're gonna do well. We just have to be more on our toes. All right. So, okay. All right. Take care, Derek, and everyone. Yep. Bye bye.
Thank you.
Yes, sir.